You're not being intellectually honest if you don't believe.
We'll dive into that clip in a moment, but first, Cathie Wood bought a lot more Tesla stock yesterday, about $30 million worth of Tesla stock. This screenshot is from the end of December, and usually she just bought about $3 to $4 million worth of Tesla stock each time, so this is about 10 times more than her previous usual. This time, Cathie Wood is not waiting for the stock to drop a lot more. She just buys it once it drops, even just a little bit, and for a good reason, because the stock is already up today, so that was a smart move on Cathie's part. And Cathie Wood is not the only one buying. The all-in Tesla stock investor, who is a billionaire, Leo Cogwan, has also bought a whole lot more Tesla stock, 500,000 more shares, which, depending exactly which days he bought, that could be up to about maybe $100 million worth of Tesla stock. In the meantime, a legacy automaker, Stellantis, offers buyouts to 33,500 hourly salaried workers. These automakers are starting to feel the pain, and don't worry, more pain is coming for them. I expect that Tesla will cut the Model 3 prices further, but likely, eventually, the Model Y prices, in somewhat rather near term, may increase if the inventory reaches zero and stays there for a while. Ark Invest chief futurist Brett Winton was just on TV, so let's take a look.
Great to have you with us. It's always great to have a futurist on. We're usually so focused on the here and now.
If you don't think long term, this happens.
Well, to some extent, one could say that sort of the opportunities come and gone.
Many investors sold Tesla stock back in 2019 and never really got back in. Think long term. Brett is about to talk a little bit about Google and Microsoft, but it will all come back to Tesla.
So we're focused on what happened actually last night in terms of Microsoft and Alphabet, and I'm wondering what your take from it is. You know, the Wall Street take is that Microsoft is in the lead. What's the futurist take?
I think Microsoft is more in the lead, and this is a platform transition. And typically in platform transitions, the companies that you're looking at aren't the companies that actually win. If you go back to when the PC arose, imagine you would pre-imagine that the PC was going to be a revolutionary device that was going to be in everybody's home. You might have been long IBM because IBM was the PC company, and you would have been totally wrong. Or entering the internet age, Bill Gates saw the internet coming, and he told Microsoft it was coming, and they lost. They missed out. They lost to Google. They lost to Yahoo even, and they lost to Facebook. And so here we are approaching this event horizon that is AI, and Google has all of the AI talent in the world. Hey, they've just restructured the AI division, so it's part of their core team, and they are not structurally set up to benefit from it. And it's reflecting the results today, but I think over the coming months and years, it's actually going to become more profound. They have a lot to lose in core search, and they haven't really figured out how to respond to how large language models are going to change that business product.
This is actually really important to think about, because you could say, well, Tesla is the first company to work on full self-driving, isn't it? And that sort of, historically speaking, actually puts Tesla at a disadvantage to a certain extent, because a lot of the times when there are these big transitions, the incumbents do not win. Think about Friendster. That was one of the first bigger social networks. I have not heard about Friendster for decades now. Same with MySpace. Where is that? Facebook took over. But the reality is, Tesla is not the first company to work on a fully self-driving car. Actually, Google worked on it way before Tesla even started trying to work on it. And the argument that the company that first enters the new industry does not always win, or usually even, does that apply to Tesla's EV business? I think you could have made that argument maybe 10 years ago, that there is a high risk of that happening. But now, this year, Tesla is going to sell more cars than some of the legacy automakers, more vehicles than Audi, for example, probably.
So in my notes, Brad, it has that you believe that there are other ways to play AI, and you name Tesla, Caterpillar, and Deere. And so I'm wondering why you think these, and you might not necessarily think about Caterpillar and Deere immediately when you're thinking about AI, but why would you say that these are other ways to play? Are they better ways to play than a Microsoft and Google? Because it seems it doesn't seem like you can say that Caterpillar and Deere can monetize in X, Y in such a tangible way that Satya Nadella elaborated on last night.
It's more like, do you want to be trying to pick the winner between two companies that are going to try to tear each other apart? Or would you rather look at companies that have assets in the field that others can't duplicate or replace, that they will be able to deliver AI software against to improve the financial characteristics of those assets? In the case of Tesla, it's a really simple case. They have the largest deployed fleet of robots in the world. If they can turn those cars that they have on the road today into robo-taxis, those cars go from things they've sold once and generated operating earnings on once to assets that generate ongoing operating earnings year after year after year as they operate as robo-taxis. And you're not being intellectually honest if you don't believe that the odds of robo-taxi being successful on Tesla isn't improved now relative to where it was a year ago, given how fast AI is accelerating.
I understand why some Tesla stock investors are really jaded because Elon said full self-driving is going to be sold next year, and he said that a few years ago, and then every single year after that. I get it. But this also presents a huge opportunity because most investors at this point really don't have much conviction in full self-driving, which creates this very bizarre opportunity. Objectively, today, full self-driving is closer to being solved by Tesla than it was, let's say, 2 years ago. But optimism about full self-driving back then was higher than right now, which means Tesla is actually doing better, but it's priced in at a lower price. Now think about that. I actually just had a quick drive and I went to a restaurant, no disengagements, nothing. It drove me perfectly from where I started to my destination. That's definitely not the default, but the fact is, Tesla is certainly closer to solving full self-driving than it was 2 or 3 years ago, when optimism was actually higher, where that was priced in at a higher price than it is today. And before, you could have made the argument that Elon is so bullish on full self-driving because his Tesla stock options had not vested, but now they have. And in Q1, Elon did not mention full self-driving is going to be solid this year, but in this last earnings call, he did mention that, although he was very hesitant to say that, and the chances are probably it's not going to be solved this year. I think the chances of that are higher, but eventually one year Elon is going to be right. And until then, I think Elon is going to keep saying every single year, oh, this year we got it. But when Elon says it now, I don't see any reason to think that he actually does not believe in that. He may be wrong, but that's very different from, oh, you think Elon is just being not genuine.
There are other more defensible plays on the acceleration in AI than the mega tech companies that are all teetering on the brink of a platform transition that is incredibly treacherous.
Brett, this sounds to me, hey, Tim, thanks for joining us. It sounds to me, though, there's an evolution here that's not dissimilar from what we've seen in the financial industry, where fintech isn't necessarily, a lot of companies claim they are fintech players, but if you look at the mega cap banks, they're as fintech as anybody. When I hear about a Caterpillar's AI strategy, or when it's kind of like everyone's in the cloud. Doesn't it just seem that ultimately every business is going to incorporate AI, some better than others? But that I bring it back to Microsoft. Microsoft putting it in Office 365 products right now, maybe they can monetize it, but they're charged. It's a software company. They charge for their services. Are they going to break it out separately? They're probably keeping it and making it a vital part of Office 365 so they can just keep pricing where it is.
Yeah, the difference or the similarity that you're identifying is that, Microsoft is already charging for a product, and that product will become a lot more useful to users, and so they'll be able to charge more. It's the same with Caterpillar. It's the same with Tesla, to be honest. They have already charged for a product, and suddenly that product is going to become a lot more useful because of AI. So you can look across the landscape, both at the companies that are helping all of these companies generate AI models that they can deploy against their assets. And you can look at the companies that have that distribution, that have those assets.
Tesla's full self-driving take rate is about 10%, a bit under 10% globally, but closer to 15% in the US. Even if, let's say, once full self-driving is solved, there is a regulatory approval delay, a huge delay, let's say, still a lot more people are going to buy full self-driving just for themselves because they won't really need to drive that anymore.
And so in Microsoft's case, it's their billion, Office users that will become a lot more productive because of their products. On the other side, Google's core search business does not directly charge users and actually may be impaired as AI models deliver answers rather than deliver customers to additional websites. And so they're really vulnerable here against their cash cow. And so that's why I think, the quarterly results are one thing. The 2 or 3 year structural results actually look much more dire from my perspective for Google. They haven't figured out how to respond. And if you're 6 months behind in AI, that's the equivalent of being 2 years behind in traditional technology, given how quickly costs are declining.
If you go with that assumption, think about just how far behind other companies that are trying to solve full self-driving as well are behind Tesla. Tesla has many years in terms of the lead, so much more data, so many vehicles actually on the roads collecting real data. Everyone else is doing simulations or they just have a few cars on the roads. Tesla has millions of vehicles on the roads now. If data is the main key to solving full self-driving, which when you look at all other AI technologies, pretty much the more data you have, the better the model is going to be. That's one of the reasons why ChatGPT keeps getting better with each newer version. Assuming that is the case for full self-driving as well, which I believe it is, as it has been demonstrated with AI companies, clearly Tesla is in the lead.
Across all of our companies right now, the primary question we're asking is, how is this company going to enable, deploy, or take advantage of the acceleration in AI? Because it's going to change every sector and accelerate every technology.
And Tesla, of course, is perfectly well positioned to take advantage of the advancements in AI. And this video explains why the Tesla board members are now buying more Tesla stock. My name is Matt. Post this, like, and subscribe if you haven't yet, and I will see you in the next video. Thank you so much for watching.